From the banking space, Chanda, Kochhar, Managing Director and CEO, ICICI Bank joins in as we celebrate 5 years of excellence on ET Now. First up, Ms. Kochhar, congratulations on completing 5 years as the Managing Director of the largest private bank. And, clearly the past 5 years haven't been the most smooth for the sector. What has been the biggest challenge from your point of view?
Thank you. I think the last few years have had their own set of challenges on the economic front, and I've always said that the banking sector really rides on the real economy. So we saw growth slow down, we saw a slowdown on corporate investment activity, we saw the cash flows of the corporate sector getting tighter and a dwindling of confidence. But I think during that period what we did was we focused on managing risk and growth both simultaneously, and that's how we have managed to grow the bank and at the same time to actually get to a sustainable, profitable growth model.
How does ICICI Bank and the plans change with this change in the economic sentiment and the feel-good factor that is so overwhelming at present? Are you looking to shift gears and grow aggressively from here on?
Well, I think we would definitely grow in line with the growth in the economy. As you've seen, our retail business has actually already been growing at upwards of 20%. On the corporate front, we will get back to growth in line as the corporate investment activity comes back. But our plan is that as the growth comes back for the banking sector, we would as ICICI Bank grow about 2 to 4% higher than industry growth rate. And at the same time, our plan is to maintain our return on assets. And I think that is what is going to keep giving us the improvement in the ROE that we are working towards.
Let's talk long term, and what's the outlook on credit growth, especially on the corporate side? Will we see credit growth being driven by retail for the bank in FY15 as well?
So we are a true universal bank, and we grow in line with all the growth opportunities that occur in the economy. The last couple of years, really the growth in the economy has been on the retail side, and that's why you've seen our portfolio growing at upwards of 20% on the retail side. As we look forward, the growth on the retail will continue, but at the same time as investment activity picks up, the growth on the corporate side would also come back.
What are the early trends on asset quality looking like for ICICI Bank? Do you expect FY15 will be a much better year?
Miss, I actually expect that a lot of decisions should come around clearing the existing projects that are stuck. So if the existing projects that are stuck get cleared and they start generating cash flows, clearly you would see improvement on the entire financial health of the corporate sector. Similarly, some amount of structural changes on the infrastructure side, clearing of overdues by the government sector towards the private sector. I think all these things would go towards easing the cash flow situations on the corporate side. So given that, I think we've peaked in terms of the addition to restructured and NPA assets. While going forward, there would still be some additions, but clearly I expect that the additions in FY15 should be lower than the additions in FY14.
Ms. Kochhar, give us a sense of your margins growth for the year. Could one expect margins to be maintained at the current levels?
Yes, we've been focusing on, in the past improving our net interest margins, and in the last 3 to 4 years we made a substantial improvement. Today our net interest margins are about 3.3%. And clearly our focus is that we would maintain these margins. We plan to do that by continuing to focus on our CASA deposits, making sure that the CASA deposits remain between 38 to 40% of our total deposits. So clearly we would focus on maintaining our margins as we go forward.
And what are your plans on the fundraising front? Have you, is there anything that you've already chalked out, whether it's domestic or overseas as yet?
Fundraising, of course, is of two kinds: equity and debt. As far as just raising bonds and normal debt is concerned, I think that's the normal business operations of a bank, you always keep raising funds, especially long-term funds, based on the opportunities and interest rates that are there in the market. So, that you would see us doing all the time. But as far as equity is concerned, we actually do not need more equity. Currently, we are very well capitalized. In fact, amongst the large banks in India, we are the best capitalized bank, having a tier 1 capital of almost 13%. So, we do not need to raise equity for some time.
And lastly, Ms. Kochhar, are you looking at unlocking value from any of your subsidiaries? There are indications that the government may be open to raising the FDI cap in insurance. So, if that were to happen, would you look at a listing?
See, our insurance subsidiaries are also, growing very well, but at the same time capitalized very well. So, in that sense, we do not need additional capital in the insurance subsidiaries to meet the growth requirements. But of course, as the rules change, as the markets change, we would always look at monetizing some amount of our existing investments in the insurance subsidiaries. But since we are in no hurry to raise capital either at the bank or the insurance companies, we would do it at a time where we feel the valuations are most optimum. So, while we would monetize something in the medium term, there is nothing in the offing in the immediate term.